back by about 0.1% on the S&P. On the Nasdaq, we're negative by 0.16%. The opening bell in New York rings. There we go. Switch to the board and get to the bond market. Yields look like this. We're down about 5 basis points on a 10-year to 493.71. Cycle highs this week. 2-year, 5-year, 10-year, 30-year. What a week it's been in the bond market. Even with this move lower, this week the 10-year yield higher by more than 30 basis points. In the FX market, the euro going nowhere. 105.84 unchanged on that currency pair. Crude going somewhere. 2 weeks of gains. Back into the 90s on WTI, up by 0.9% this morning. One stock to watch at the open, Amex, reporting record Q3 profits. The CEO saying this: the investments we have made in our value propositions are driving brand relevance across generations. Abby has more. Hey, Abby.
Hey, John, and yes, so there's the good part of the quarter, which is basically the surface. They did beat top and bottom line estimates, record profits, as you just mentioned, and that really has a lot to do with demand for their premium products, such as the Platinum card, along with the travel Gold card. Now, speaking of travel, that's what's driven a lot of their business over the last couple of years, that revenge travel coming out of the pandemic. What that creates, though, what investors don't like, with the stock now down 3.4%, is the fact that it's tough comps. The growth does not look as attractive for American Express, given the fact that this is going on relative to the strong revenge spending. So growth in spending on the cards is slowing. It's making those unfavorable comparisons. Plus, their total network volume, while up 7%, that missed estimates. It's the lowest growth in 10 quarters. The stock on the year into today up a little bit. Right now, we're looking at the stock near session lows, down about 3%. That, of course, is the worst day in a bit of time here. And it's trading sideways, John, in a range between 140 and 180. Investors can't figure out what to make of American Express.
145.40 right now. Abby, thanks for that. Let's stick with banking. Regions Financial falling short of Q3 earnings estimates. The CEO with this line: while the industry continues to face economic and regulatory uncertainty, we're confident in our ability to adapt to the changing landscape. Shonali has this story. Hey, Shonali.
Good morning, John. When you look at the regional banks, Regions Financials is just one of those banks that have already been down more than 20% on the year. And now not only is their net interest margins missing expectations, you also have their outlook starting to concern investors, with Evercore ISI saying that it's a net negative, this outlook that they have, likely pressured on the NII and net interest margin miss, and greater pressure than expected on funding costs, expense noise, and all that mounting credit pressure. They're one regional bank among many that are facing such problems, and you see that in the stock this morning, down another 12%. If you take a look at the KBW Bank Index, you're looking at most banks in the index certainly down. Really only JP Morgan Chase that is up anymore year to date at more than 8%, but everything else is down from 0.2% to 54% if you look at First Horizons. Not bad news everywhere. Take a look at Western Alliance really quickly here. It's getting just a little bit of a lift here on that beat. I'm sorry, everything is a miss these days. The beat that they had in net interest income. So you are seeing banks still trying to lend into this environment and also beat on credit costs, but it is a messy story among the regionals, and that continued pressure is still of great concern for credit markets.
Shonali, help me frame this. Is it JP Morgan versus everybody else, or is it the large banks versus the small banks still?
Can you say both somehow? At the end of the day, JP Morgan is just so big, and you see that in the bid that it's getting in the stock market. Its price to book ratio, it's trading at more than 1.5 times its book value, and almost everything else is starting to trade below. A really difficult moment for the banking industry here, John.
Huge gap opening up this year. Shonali, thanks for that. Thanks for the update. The latest on the financials there, the regionals specifically. Let's turn to the transports. Knight-Swift Transportation, topping profit and revenue estimates. The CEO with this line: we remain excited about the future of this business and continue to work on growing organically and through strategic opportunities. Katie on top of this story. Hey, Katie.
Hey, John. Well, there's a lot to be excited about. You look at the stock market right now, Knight-Swift is soaring at the moment, up almost 12% or so. And let's get into some of the numbers here, because it really was a beat across the board. You take a look at third quarter adjusted EPS. It came in at about 41 cents. Analysts had been looking for 36 6 cents. You also saw total revenue beat as well, just above $2 billion. The estimate there was for $1.9 billion. And looking forward, Knight-Swift also narrowed its adjusted earnings guidance for the year. That topped the average analyst estimate in the process. Now, the sell side opened these numbers with open arms. You take a look at J.P. Morgan. They upgraded the stock to neutral, and their reasoning there was that the U.S. Express acquisition is making progress sooner than expected. Morgan Stanley, meanwhile, reinstated the stock as a top pick, and that's actually lifting industry peers as well. You take a look at J.B. Hunt and C.H. Robinson rising alongside Knight-Swift right now.
Katie, thank you. Thanks for the update. Look out for Katie later at the close with Remain Bostic. Looking at that name, this name on my screen right now. Tesla. Tesla yesterday with a really difficult session, down by more than 9%. Biggest one-day loss since July. The latest news on Tesla for you this morning, recalling over 4,000 Model X vehicles in China due to brake issues. This according to a statement from a Chinese regulator saying the following. The alarm may not be issued when the level is low. In extreme cases, it may affect the vehicle's braking and increase the risk of collision. Ed Ludlow with the update. Morning, Ed.
Yeah, good morning, Jonathan. Tesla down 2.4%, extending its declines. This puts Tesla on track for its biggest weekly drop of 2023, the worst week of the year. A lot of that downward pressure continues on from Wednesday night in that quarterly earnings report where there was a top and bottom line miss, reiterating guidance that it will deliver 1.8 million units this year, or produce 1.8 million units this year, but much bigger macro concerns. As it relates to the China recall, this is a soft recall in the sense that those more than 4,000 vehicles that are impacted, the solution is an over-the-air update fix, which is a pretty commonplace occurrence when it comes to so-called recalls out of China that are mandated by the regulator. But, you know, the story's really changed, right? Elon Musk really focusing on the rates narrative, the macro environment that Tesla is operating in, and now there is a concern that the lever of price cuts that they've used to drive growth, which the target is 50% annual growth for Tesla, it won't work going forward, and it's not going to be the same sort of effective lever. And if you go on ANR on your Bloomberg terminal, it's just interesting to see on a 12-month price target basis trajectory change and where analysts see this stock going right now.
Ed, this just isn't a Tesla story. It seems to be the whole sector. I hear a lot of reports about EVs, unsold EVs piling up. Ed, what's happening?
Yeah, I think especially if you read our own Bloomberg Intelligence analysis, there is now a question mark over how robust consumer EV demand is, right? And I think that the story that will be increasingly written is that those early adopters, those most inclined to transition to an electric drivetrain, may have done so. How do you take the rest of the market? You know, the way that it always gets explained to me by investors and market participants is like, a car is the most expensive thing you'll buy in your lifetime apart from a house. And the rate environment impacts that. Financing of those cars impacts that. And even though prices have come down, largely driven by Tesla's price cut initiative, it's still elevated for a battery electric vehicle relative to a combustion engine car for most middle income households, particularly in this country, John.
It's too expensive. Ed, thank you, sir. The latest on autos. Let's talk about houses as well. We put out this story yesterday. Home buyers needed a $114,000 salary to afford a typical home in America in the month of September. This assumes a 7.2% mortgage rate, if you can find one that low, with 20% down on a medium price home of something a little north of $400,000. This according to real estate brokerage Redfin. To comfortably afford a home payment, this is the basic assumption, a buyer should spend no more than 30% of their income on housing costs. So let's go back to what this used to look like. Think about back in, say, 2012. The average requirement was roughly $38,000 to access the average home. It is now six figures, $114,000. Salary. Is it any surprise that people can't afford the EVs that are coming to market? Let's talk more broadly about the broader financial markets. Sarah Hunt of Alpine Saxon Wood seeing a challenging road ahead for equity markets, writing this. A higher for longer rate environment risks the repricing of assets after more than a decade of zero rates. It seems very unlikely that repricing would be to the upside. Sarah Hunt, I'm pleased to say, joined us right now. Sarah, let's talk about what companies are saying about this economy and who's got pricing power. We just talked about Tesla cutting prices. Yesterday, Netflix, we could talk about them hiking prices. Sarah, who's got pricing power right now?
very uneven across different sectors. And I think that this is part of the problem and part of why people are having trouble figuring out what happens into next year. I would argue that it's going to be a challenge to think that you can get a 12% earnings growth for the entire S&P. I think there are some places where you will get it. I think you've seen some pricing power in some of the technology sectors. I think you've seen it in some places, but higher interest rates really takes a bite out of that pricing power, especially when you're talking about high-ticket items.
It's so difficult to get a read on discretionary spending right now, particularly given the example I just gave. But if you throw in what we heard from LVMH saying that they've seen the post-pandemic boom, it's over. What the airlines have indicated this week, American Airlines again. Sarah, where do you see that strength for the consumer at the moment? I see it in retail sales, but at the sector level, at the stock level, where do you find it?
I think you have to look at some of the smaller budgetary items, because think about that. I mean, what just happened with American Express too. I mean, we're saying we've got really good numbers and everything's going really well, but you're seeing a drop in that growth of travel spending and some of those expensive items. I think that's really the problem. Some of your textile works, are you still going to buy an iPhone? You probably are. Are you going to take an extra vacation? You might not. I think that there's going to be a real change in the way that we've been acting, and how to predict that change is obviously one of the biggest challenges that we all have right now.
Well, the consumer for most of this year, as you know, Sarah, has been surprising to the upside. I've called it the 3-month rolling recession call. We just keep pushing it out. Barry Bannister of Stifel was on a program earlier this week. He was talking about the slowdown coming. Guess when? Back half of 2024. Is the bigger risk for you, Sarah, that that slowdown comes sooner or it gets pushed out later?
I think the biggest risk is that we have this, not just the rolling recession call, right? It's also the rolling what's going to happen with interest rates call. The chart that you put up earlier when you were talking to Mohammed Al-Arian, where it looks like we have 1 or 2 more rate hikes and then all of a sudden we see rates come down dramatically. The market's also been pricing that combination of we're rolling out a recession, we're going to have rate cuts. And I think that the strength in the consumer has had, and the labor markets has had this effect that has allowed companies to continue to earn. The question really is, when do those margins start to get hit? And that has been the magical question. And so far, no one's actually nailed the timing of it completely right. But I think that you do start to see some weakness. You're seeing it now in the way that companies are talking about their forward numbers on their third quarter calls. And I think that as we get through this earnings season, we're going to see some projection of that. Although I doubt you're going to see anybody who wants to tackle what they're going to look like in 2024.
Let's work through the market right now. What's playing out on the screen? The 10-year yield lower by 6 or 7 basis points, pulling back from multi-decade highs at the front end. We were through 520 early this week. We're down 5 basis points this morning to about 5.1%. On a 30-year, the 2-year is basically where the 30-year is right now. The 30-year is at 5.077%. That yield's lower by about 3 basis points on the session. That's the bond market. About 12 minutes into the equity market session, we're negative by just 0.1% on the NASDAQ. On the S&P 500, virtually unchanged. If you're looking at crude, back in the 90s, Sarah, WTI, $90.30, up by 1% this morning. You've had a preference for energy for a while. Sarah, is that a place you want to stay?
I think it is. I mean, the really unfortunate thing is that what's going on right now in the Middle East only exacerbates the problems that you see in the energy sector. And I think that this consumer reluctance to get to the next level of EV vehicles, I think there's still challenges. And the hydrocarbons that people have been talking about phasing out over the next decade or so, I think are here to stay with us longer. And I continue to believe that energy is not a bad place to be. And I think that right now, unfortunately, for everybody, that is coming to the fore in a geopolitical way as well.
Big combination with Exxon in the last couple of weeks, Sarah. Are you expecting to see more of the same from others?
I think you will. I mean, I think that, it's hard in the energy stance to say that all the acquisitions end up making sense. They certainly sometimes take a couple of years to play out. And I think that you are going to see that. I mean, this is all about efficiencies, right? In the end, there's also what's coming forward in the next year or two. Well, people are looking for ways to save money. Well, how do you do that? You combine into a bigger company, and then you can take some of the costs out. Look at all the announcements that are being made right now after Credit Suisse was absorbed. I think that there's going to be continuing merger and acquisition activity, because I think you have to be bigger to be able to navigate some of the cost structures and some of the political structures as well.
Sarah, great to catch up, to get the update from you, the team. Sarah Hunt there of Alpine Saxon Woods. If you're just joining us, we're about 13 minutes into the session. We are pulling back just a touch, no drama. We're down on the week, down just a little bit on the session by 1/10%. Coming up, some potential progress out of Detroit.
As the UAW strike against Ford continues, we are at a crossroads. This is about the future of the American automobile industry.
The UAW inching closer to a deal with General Motors. That conversation up next.
As the UAW strike against Ford continues, we are at a crossroads. Choosing the right path isn't just about Ford's future and our ability to compete. This is about the future of the American automobile industry. It should be Ford and the UAW versus Toyota, Honda, Tesla, and all the Chinese companies that want to enter our home market.
That was Ford Chairman Bill Ford speaking on Monday. Today, the union and GM moving closer to a tentative agreement, according to a negotiator. UAW Vice President Mike Booth saying this: all the pieces are there, we just have to glue it together. Attention now shifting to Union President Shawn Fain, expected to provide an update at 4 p.m. Eastern Time. Your team coverage begins right now with Bloomberg's Anne-Marie in Washington alongside David Welch over in Detroit. David, first to you. Are we close to a deal here?
Well, there's some operative words here in that story. First off, the headline, inching toward a deal. So they've probably got a few feet to walk, but they do need to glue all this together. I think Mike Booth is giving us the straight dope on that. The trouble with these labor deals is often it gets down to the wire, like, fairly close, like I think they are, and somebody wants something else, and that could take more time to iron out. Like GM still hasn't come to 23% pay increase over the 4 years. They're at 20%. Ford's at 23. I think they're going to have to do that. And Mike Booth also told us yesterday they still need to come to an agreement on retiree benefits. It sounds like it won't be a pension. It'll be a 401k, but a very nice one, and they still need to finalize numbers on that. And then, there's side letters on how they will handle future battery plant workers. I think they probably have a decent understanding there, but then once the attorneys get in and the specifics happen, these things can take a bit more time. But this is the most positive commentary we've heard from either side about this probably the entire time, because there's been a lot of nasty rhetoric for the last 5 weeks.
True. Excuse the pun, but how much gas is in the UAW tank? Can they afford to drag this out much longer, David?
Sure, they haven't actually spent all that much because they're really only striking a small number of plants and a relatively small number of workers. They had about $825 million going into this. They could have struck every plant at all three companies for 7 weeks, and they've spent far less than that. They spent 5 weeks at just a relatively small number of facilities. So they've got money to continue this.
What would trigger an escalation for them, David? What do you think it would be? We heard about the F-Series plant being targeted. What would be the escalatory move from UAW now for these three automakers in Detroit?
I think when Shawn Fain takes the Facebook Live event at 4 o'clock, if there are just a few things that he really wants, and they're just not, he's not getting exactly what he thinks will move the needle, then he could put up some last-minute pressure by walking out at some other plants. When Mike Booth says the pieces are there, but they need to be glued together, I think there is a general framework, and that the union has, as Ford has said, pushed the companies almost as far as they can in terms of what they are willing to spend on this 4-year labor agreement. But at the last minute, the union can apply pressure to try to squeeze a little bit more out of the companies, and with a lot more in their strike fund to do it, I think they could.
MH, a good reason for this White House. This story's fallen off the radar. Where's it going?
Well, Jonathan, I think if there's able to be an agreement, that's going to be welcome news for this White House. They want to see a fair agreement for the unions, but obviously, of course, they'd like to see this be done and finished with so they can move on, because the concern is that this can cause a recession in a place like Michigan. I also like to note, Jonathan, I was pretty struck by some of the numbers we saw yesterday in the Bloomberg News Morning Consult poll. While Biden does hold the union vote still overall, he beats Trump by 11 percentage points. Look at these pockets in some of these swing states like Arizona, Pennsylvania, and Wisconsin. Trump is eating at those voters. So for President Biden, this shows to me, yes, he wants to be the most pro-labor union president in modern history. We all know the slogan, but it does look like he still has some work to do.
To your point, does he have the union vote, Anne-Marie? And if he doesn't, does the former president have it?
Well, that's a great question. At the moment, according to our poll, overall, he has the union vote. But the issue is that former President Trump is starting to eat away. He is starting to gain favor with some of these union households. Look at a place like Michigan. Our poll shows that Biden holds the union households by 11 percentage points in Michigan. In 2020, John, when he won Michigan, he had about 25 percentage points of those union households. That's less than half. So it shows to me that the president has a lot of work to do, and also potentially being the most pro-labor union president isn't necessarily top of mind of these voters. What is top of mind of these voters is inflation and the fact that they feel like their wages are not keeping up with the price of everyday goods like groceries and like gasoline, Jonathan.
MH, thank you. Alongside David Welch on the latest from Washington and Detroit, respectively, inching towards a deal between UAW and GM. As David Welch put it, maybe, sure, we're inching towards a deal, but we still have a couple of feet to go. If you're just tuning in about 23 minutes into the session, pulling back by 0.2% on the S&P. Let's get you some sector price action. Here's Abby.
Interesting sector action today, John, because we do have this small decline for the S&P 500, and yet more sectors are higher than not. And also interesting is with yields down, we have some of those rich dividend sectors on top: real estate, utilities, consumer staples. Toward the bottom, we do have energy, even with oil higher. On the week, we are, of course, talking about that first down week in 3, as you mentioned earlier, down about 1%. Two of the best sectors, energy and consumer staples, and then two of the worst sectors, real estate and discretionary. Most sectors, not surprisingly, on the week are down, again with the S&P 500 heading toward a 1% loss.
Abby, thank you. Up next, a sneak peek of next week, your trading diary coming up. Stocks down just a touch on the session and on the week. We're down by 0.2%. That's the price action. Let's get to the trading diary. Coming up, the US-EU summit kicking off at noon Eastern from the White House. Plus, Fed President Mester speaking before the quiet period. Next Tuesday, earnings from General Motors, Alphabet and Microsoft. Wednesday, Meta and IBM. Thursday, more results from Intel and Amazon. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. I'll be away next week. I'll see you the week after that. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, October 20th. Here are the top market stories that we're following for you at this hour. Time to buy the dip? Well, Bank of America says sentiment's so bad, it's now triggered a contrarian buy signal. So, time for the safety trade? Money flowing into bonds and gold. We're going to dissect the safety trade into the weekend. And time to sell solar. Solar Edge sinks. Customers cancel and delay orders. Inventory piles up. The stock drags down the whole solar sector. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, obviously there's somewhat of a risk-off headed into the weekend, and then under the hood there's some really powerful earnings movers within the S&P, from regional banks to Solar Edge. That's the micro story right now.
That Solar Edge story making me feel very dark. The sun seems to have vanished from the sky, certainly in that sector. But I think more broadly, look, I think the only thing you can take away from today is that everybody's hunkering down a little bit into the weekend. Stocks are off, bonds are bid. The UK 30-year was on offer a little bit earlier on, but I think broadly the sentiment, certainly at the front end, is that you're looking for a place to hide out. That gold story, absolutely front and center on that. So I'm not sure there's anything we can take away, but I think on the week it's a different matter. On the week, sentiment is getting pretty bad out there, and I hear what Hartnett is saying at Bank of America. Are we at the point now where you can sort of start to dip your toe in because of that negativity? I don't know. You talk to a lot of people out there, they're very bearish. Is there more are there more bears to come?
I mean, it's possible, but I have to say, looking into the weekend, Guy, I'm excited because you're going to get on a plane on Sunday morning to come to New York. You'll be in the studio right next to me. The floor crew right now is doing this. Very excited to have you here all next week.
I'm looking forward to it. Look, we got a great Monday lined up. I've got this theory, right? If you want to know what's happening in the world, and many of us do, there's a few people you want to ask. And the people you really want to ask are airline CEOs. Because if you think about it, airline CEOs, they know all about the oil price story at the moment. They know all about the consumer trend story. They know all about corporate spending. They know all about the supply chain story. They know all about the geopolitics. Basically, if you want to know what's happening, ask an airline CEO. And on Monday, we are going to do just that. We've got these two in the studio, Shai Weiss, Ed Bastian, Virgin Atlantic CEO, Delta Airlines CEO. It is going to be a great conversation. Will we be any of the wiser at the end of it? I suspect so.
Yeah, I'm looking forward to it. You're looking forward to it. And because you did the promo, I'm going to do the question of the day. We're just going to go to it because that's sort of the outlook that we're going to get on Monday. Right now, we're going to go to that Bank of America note that Michael Hartnett had out, which is sentiment bad enough now to buy the dip? And you can make the argument whether it's for bonds or whether it's for equities. Bloomberg's Liz McCormick and Abigail Doolittle join us now. Abigail, I'm going to start with you because you also look at the charts and technicals. And I'm wondering, when you look at RSI, you look at sentiment, what do you think? Is sentiment bad enough to buy?
I don't think so. I'm kind of surprised by the finding of this survey. And if you were to define different measures of sentiment, whether it's the VIX, whether it's dispersion and correlations, or the charts, the S&P 500 is not even down on its 200-day moving average yet. The Russell 2000 right now down 13%. The S&P 500 from its July high is down just about 7%, still above the 200-day moving average. So I think we need to see more selling. Now, for a longer-term sell-off, you also want to bring in a capitulation idea. You want to bring in credit, CDS. You also want to bring in bonds, some kind of a haven rally. So right now, for a near-term dip buying opportunity, maybe for like a week or two, maybe, but for longer term, I don't think so. I think there's a lot more selling to go.
Liz, happy Friday. How's the sentiment?
Yeah, I mean, I know we like banter back and forth, but I would lean towards Abigail's sentiment, too, that I think the sentiment, like you said, Guy, isn't great. People are feeling stressed, worried. There's so many issues around the globe. But I don't think people feel confident enough to buy the dip, whether like Abigail is mostly talking about stocks, but even in bonds, unless you go very short end, very haven. And we did see some money come out of money market funds yesterday. So that shows maybe people are, like you say, Guy, dipping their toes into other things. But, I mean, look at the volatility in the rates market, the long bond yields, everything, like you said, yields are down today. But you just kind of can't figure one day they're down and then we're seeing double-digit increases. Yeah. So I don't think people want to buy duration. That's not quite like the capitulation in the bond market enough, even though it's been brutal, to kind of step in.
Yeah, fair enough. I wonder, though, and this was sort of in the note, Michael Harnett talked about this, it kind of removes, though, some upside. So this is obviously to stocks, Liz, but if the index can't hold at 4,200, so we are trading somewhere, hold on, I probably should have pulled that up before I started this. So we're trading at 4,261. Then with this level of bearishness, and there may be imminent risks of a credit event or hard landing. So Abigail, I'm just going to go with you on this one because I found that quite interesting too, that maybe it doesn't mean buy the dip, but it does definitely cap upside.
Yeah, I think it would cap upside in a lot of ways in terms of buying the dip. I mean, I think that there's a lot of different things going. I think that investors are on warning that there could be some worse selling ahead, and that is that idea of that capped upside that you're talking about. Relative to the S&P 500, I think that it's pretty clear that we could go from a technical perspective, and again, going below the 200-day moving average, we could go down to 3,900. On the uncertainty of that Liz was talking about, if we bring in, the geopolitical tensions, the consumer. But I think that the thing that's really going on here is this weird tension between the Fed and bond traders. So here you have, or I should say bond traders as the haven, because you have the Fed clearly supporting yields going higher, at least that's my view of the situation. So for us to see some haven buying, there has to be a real risk-off event. Capitulation. The VIX has started to go into backwardation, which is a way of saying that the current VIX is higher than further out, so people are really worried about the near here and now. Once that situation becomes worse, at that point, that might be some, a buy the dip type of situation. But yeah, there does seem to be a cap in terms of how high right now stocks could go.
Liz, how bad do you think sentiment is? I'm going to park the bond market to one side for the moment because I think the bond market is dealing with other issues at the moment. So let's ignore the bond market. But I look at the Swiss franc and I look at gold. Gold's rising in a rising yield environment, which is completely counterintuitive. That shouldn't be happening. The dollar's also reasonably strong as well, so that shouldn't be happening either. How big a signal, how big a tell is gold giving us, do you think, right now on how beaten up sentiment really is?
Yeah, and I think, if you read Eddie Vanderwalt's with our MLive crew, done some good stuff saying that if you kind of factor out, like you're getting at, Guy, where gold should be given rates and other things, there's even more of a premium in gold, than you see just in the price in front of your screen. So I think there is enough, fear and sentiment because, let's all be humble. And I think, so the smartest people, say that, even at the Fed, that we don't know. You don't know where the inflection point is going to be in the market. So you have to start hedging, buying things like gold, dipping your toes into haven stuff, even though, things are not working right, like we talked about the bond market. Even long-term investors, you just don't know. So you have to kind of just be careful. So I think you're right. Sentiment is souring. I mean, to me, the key thing is people will keep spending as long as they have jobs, right? So it comes back to the labor market cracking. So you're not feeling as good, but if you have an income, you're still kind of spending and can keep up. So I think it comes back to the Fed's focus that if the labor market starts to crack, then sentiment is going to even get worse than it's been dipping to.
Abigail, I also want to talk about micro for a second because we also got earnings out a bunch of different places, but particularly I want to talk about the regionals because they're getting hit really hard, particularly on Regions Financial, where they disappointed. And we're kind of waiting for more cracks to spread. And the punishment we seem to be getting when there's a miss seems to be quite extreme. What do you make of that?
Well, I think folks are really on edge because of what happened earlier this year, this idea that something broke, that something could break more. Plus, we have the commercial real estate situation. There's, I believe I forget the exact number, but many $1 trillion worth of CMBS come due by the end of 2025. Most of it spread out amongst those regional banks. But the idea that some of these regional banks, that the deposits are a little bit lower than expected. I think investors are just worried. They don't want to get caught up in, say, a Silicon Valley. I don't think it's unlikely, but I think that that's a sign of the times.
Right, so just more like you just don't want to hold that risk versus
yes, exactly.
a strong opinion necessarily in Regions Financial. All right, guys, thanks a lot. It's going to be a lot to get through here. Bloomberg's Liz McCormick and Abigail Doodle. Thank you both very much. So coming up, we're going to get more insight into our question of the day. Is sentiment bad enough to buy the dip? So Steve Sosnick, Interactive Brokers Chief Strategist, joins us next. This is Bloomberg.
Monday. Bloomberg's Guy Johnson and Alex Steele sit down for an exclusive interview with Virgin Atlantic CEO Shai Weiss and Delta CEO Ed Bastian. The health of airline companies, the future of business travel, and headwinds facing the industry. Tune in October 23rd at 11:30 a.m. Eastern, 4:30 p.m. London time on Bloomberg Television. Context changes everything.
The Fed's job is to control prices, price stability and full employment. But they have a third mandate, and that's market stability. And the MOVE index tells us that it's not stable. So I think we're going to drop on a forced technical move if Treasury auctions fail and there aren't buyers.
That was Mark Connors, 3IQ Corp head of research, speaking to Guy and I yesterday, speaking to me and Guy yesterday, and he was basically saying that the move in the MOVE index would be the equivalent to the VIX at 50. That's a really strong move there. So let's take a look at some of the market technicals, especially as it relates to volatility. Bloomberg's Abigail Doolittle joins us now. Abigail?
That is a really strong move. That would be very extreme because right now we have the VIX at 21, but I have to say the VIX at 21, the VIX is finally waking up because we've had the VIX this year for the most part below 20. If you go back historically, the VIX, a normal level that suggests normal fear and greed for the market, somewhere right around 20. But in recent years, and there have been exceptions, we have had the VIX well below 20. So the fact that it's back above 20, that suggests that investors are waking up to risks out there, uncertainty, whatever it might be, fear of recession, geopolitical, the Fed. But something else is happening. We actually have the VIX curve going into backwardation, which means that the VIX futures, November and December, are a little bit lower than the VIX itself, suggesting that investors think that right now might be a little bit more dangerous, if you will, a little bit more uncertain, a little bit more fearful than the future, which is typically not how it should be, only because we should have more certainty right now. Now, if we bring in dispersion and correlations, because of course there's been a lot of talk about how low they were, which makes it a stock pickers market, well, they are on the rise. This is a little bit busy. These are two of the SIBO indexes. What we're looking at here in white is the 1-month correlation, and then orange, the dispersion index. And you can see the dispersion index really, actually think that's reverse. You can see that they're both on the rise, pointing to more of a macro story around the markets, that investors are a little bit more concerned together. And then finally, if we wrap this together with the VIX and the S&P 500, what might it mean? Up top, this is the S&P 500. Down here is the VIX. The VIX has, for the most part, been below that 20 level, but you can see that there's, over the last few years, been between 20 and 30. The S&P 500's range, well, it's somewhere between, let's call it 3,700 and 4,500. Coming off the top, Alex, the VIX is starting to go back into that range, suggesting that right now might not be the time to buy the VIX or buy the S&P 500, that there could be some more work to the upside for the VIX and volatility and to the downside for stocks.
Abigail, really appreciate that setup. Thanks a lot, Abigail Doolittle. All right, that brings us to the question of the day, and I think that Abigail's setup would say the answer to this is no, but is sentiment bad enough to buy the dip? Here with us now, Steve Sosnick, Interactive Brokers Chief Strategist. Steve, always good to chat with you. Is sentiment bad enough to buy the dip?
I think it depends. I think it depends on the asset class. I'm not a bond expert, but I was out with some bond portfolio managers the other night, and they were finally begrudgingly admitting that 5% on the 10-year. Yeah, maybe it's worth taking a shot. Maybe it's worth dipping your toe in because they have fallen so far so fast, and the mood stinks. Equities, I'm not quite so clear. I mean, yes, Abigail was just talking about the backwardation in VIX, but that. It tells me, well, you're a commodities person. When you have a future that's normally in contango, it means that it's typically in plentiful supply. When that contango future flips to backwardation, it means the commodity in question is in short-term supply. There's a short-term excess of demand over supply. In this case, the commodity in question is volatility protection offered by VIX. So after sort of months of relentless volatility selling by institutions and individuals, all of a sudden they're caught a little bit off sides. But as she was saying, an inversion is a necessary condition for a bounce, but not a sufficient condition for a bounce.
Steve, I'm sure a night out with the bond guys. That sounds like a real giggle.
They're more fun than you think.
He's probably hungover is what's happening.
I'm sure it's a fun night out. The second thing is, what would it take to get stocks all moving in the same direction? At the moment, what we've got is stocks moving in lots of different directions, and you can see it on a daily basis. Index goes nowhere, single stocks go all over the show. What would it take? What kind of move, what kind of catalyst could we see to get stocks all moving in a single direction, be it up or down?
Well, the answer to the down question, Guy, is much simpler. If the market's love of those 7 stocks evaporates, well, then gravity takes hold and there's really no choice. I think if you really can get the sense that the economy is very strong or that the Fed has reversed course, good luck with both of those right now. But that would turn around sentiment on the positive side, and then you would get perhaps some rotation into the unloved 493 other stocks in the S&P 500.
Yeah. It looks like today, though, all of them are getting kind of hit. Like, it feels like this could wind up being one of those really ugly days where you're just going to sell into the weekend, etc. Where do you think that there's still more selling pressure to legitimately be had? We were talking about small caps having already gotten beat up a lot, but Abigail making the point that we can still get beat up even more. What do you think?
Well, I think, the reaction to Tesla yesterday was not at all helpful because we started to take out one of the 7. I wouldn't say we take it out of the mix entirely, but, if that starts to narrow to Magnificent 6, Magnificent 5, Magnificent 4, fabulous, Fantastic 4, whatever you want to call it, it starts to get really nasty. So we've already experienced narrow leadership, and I think we need sort of the conditions to improve such that people feel comfortable going home over the weekend. People feel comfortable owning the other stocks. It's an interesting phenomenon. 15 in a row Mondays have been up, which tells you that a lot of the Friday, I haven't checked the Friday, not all the Fridays have been down, but a lot of those have been relief rallies that, okay, the weekend wasn't as bad as we thought on Friday. Mondays have been up like 80% of the time this year, which is kind of odd. It's normally like 53% over time.
Maybe it's not Happy Friday, maybe it's actually Happy Monday. That's an inside joke within our team. I don't believe in Happy Mondays. Let's talk about what's happening today. What's happening today, we got a monthly expiry. Steve, do monthly expiries matter anymore?
Yes. The relative importance has diminished since we now have expiries every day, and certainly for the biggest stocks every week, for certain indices every day. But there's 2 things that are still unique about a monthly expiration. Number one, that is the AM expiring index options, and they do sort of have a gravitational pull on futures in the pre-market, and they really do set the tone for the day a lot of times. We didn't really get it this morning. We sort of settled down sort of between the levels where there were major expiring option positions. But that's always one to keep an eye on. The other thing to keep in mind is on monthly expirations, every stock has 0 DTE options. The whole point about zero-dated options are that they're expiring. Well, on expiration, they're all expiring, and so that's really the nature of it. When we talk about zero-dated options or weekly options, it's not that anything's fundamentally changed. It's just that the expiration cycle has compressed. But for the vast majority of stocks, that expiration cycle still remains monthly, and so it does still matter.
Steve, thanks a lot. We really appreciate it. Steve's the guy that you call when the markets don't make sense, basically, and be like, what's going on today, Steve? Steve Sosnick of Interactive Brokers. Thank you very much. All right, still ahead, we are now headed into big tech earnings for next week. We got through Netflix, we got through Tesla, and now it's the big guys for next week. We're going to break down what to look for next in the startup. This is Bloomberg. It is 22 past 7 on the West Coast. We want to get to the startup, where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, I'm trying to think of something creative about like clouds over San Francisco, clouds at Tesla, clouds for big tech. When it comes to next week, what we get? Microsoft, right? Amazon? I mean, the list goes on.
It's kind of a weird situation because we go into this quarter's earnings with everyone pinning their hopes on big tech. You know, we did this fantastic Tech Watch column last week about how if you look at the 5 mega caps, their average earnings growth is projected to be like 34% because we started the year with the pain with tens of thousands of jobs being cut and cost discipline, and the results are now going to show in those names you see on the screen, many of them, maybe apart from Intel, where they're just profit machines at a time where the S&P 500 as a whole is projecting flat earnings growth. But the thing is, Guy, like, what if we're wrong and tech doesn't do as well on a bottom line perspective as we think they will?
This is the story. Look, if the famous 5 do not deliver next week, all hell is going to break loose, I think. Like, this is the moment for the market. This is what has supported the market. If these guys aren't delivering, then that is a major piece of the foundation that is under pressure.
Yeah, and there's also a lot of contradictory data and reporting out there, right? So if we take Apple as a case study, from a top-line perspective, Apple's revenue is forecast to drop 1% year-on-year in the quarter. That would be the 4th straight quarter of sales declines, which Apple hasn't seen for 2 decades. And we had that third-party data saying that sales of the iPhone 15 in China are not looking good relative to the same period a year ago when they released iPhone 14. So even if they do, you know, the traditional Apple thing of just being brilliant at eking out profit, psychologically, we're worried about tech because we learned with Tesla this week, right? No matter how charismatic your leader is or how brilliant your product, there is no sort of blanket immunity to the world around you.
But what I find so interesting when we kind of lump all these companies together is that they are very different stories, right? Like Amazon has the retail component, and I get that, but it's also cloud. It's the same with Microsoft, same with Google. That's not the story for Apple and Intel in the same way. Like, we're going to lump them in, which I appreciate, but there's the idiosyncratic issues here.
Yeah, and you know, go back a quarter, you know, 1 quarter doesn't make a company's entire year, but the cloud story is really interesting, right? Usually when macro conditions are poor, you will see companies pull back on their cloud spend. The wild card is artificial intelligence and the sort of just clamor to secure high-level compute to power and train large language models. That's driven really big demand for the GPUs. We know that about NVIDIA, although that story started to tail off as well. So we might be wrong.
Ed, what about advertising? I think this is going to be fascinating. What is happening with the consumer, the labor markets? It all comes together in so many ways within the advertising space.
Yeah, and I think, you know, we look first of all to Alphabet, the parent company of Google, and then we go back to Meta probably and ask, you know, partly because they follow sequentially in the calendar. And often when Alphabet reports earnings, if it's good, you will see optimism going into Meta earnings because despite the story of the metaverse, their bread and butter is advertising. I think, you know, there is some optimism. The US economy in particular continues to defy the Federal Reserve's wishes, at least with strong data, particularly consumer-facing. And so there is some read-through on the sell side, at least, that we might see some strength toward the end of the year in ads.
You look at that retail sales number that we got earlier on. Amazing. Ed, looking forward to the coverage. You guys are going to set us up perfectly, I know, for next week. You and Caroline. Ed Ludlow, Caroline Hyde, Bloomberg Technology, coming up in around 90 minutes' time. Coming up on this show, we're going to turn our attention to what is happening in the Middle East. We're going to talk about gold. Suki Cooper is going to join us. This is Bloomberg.
It's great questions.
We're about an hour into a pretty ugly trading session on very high volume. Bloomberg's Abigail Doolittle tracking those moves. Abigail?
Yes, stocks are down for a fourth day in a row. So this is the weekly move, and you can see it's pretty brutal. The S&P 500 down 1.9%, the NASDAQ 100 and the NYSE FANG Index both down more than 2%. The move that really stands out here to me, and a big piece of why stocks are down, the first down week in 3 weeks and the worst week in 3 weeks. Take a look at the 10-year yield on the week, backing up 32 basis points, and we're off the high. So at the highs, probably closer to 40 basis points in 5 days. That's the degree of repricing of risk bond traders are seeing, finally believing that the Fed is saying what they've been saying for a year and a half, that they are in hiking mode. They're staying there, and they're making sure that inflation is not going to have a reemergence like the 1970s. Now, if we put this into the picture of credit, the S&P 500, this is the SPY here in white. In yellow and blue, we're looking at two of the bond ETFs. Yellow is LQD, corporate bond ETF, and then blue is the junk ETF. Let me make sure that I have that right. Actually, LQD, the corporate bond ETF, is the one that's actually down on the year. The fact that you have these credit indexes, ETFs down with the S&P 500 higher may suggest that today is not, or right now is not a buy the dip moment, that there's more work to the downside for all of these risk assets. There is a treasury component in both of those credit ETFs, but nonetheless, it's bearish. As for what's weighing on the S&P 500 today, Oracle is down. This has to do with disappointment over an AI event. American Express numbers, while they put up record profit, the growth not quite there. Amazon and JP Morgan both down as well. But one bright spot, let's take a look at it over the last 2 weeks. There's more than this, I'm sure, but one bright spot for sure is gold. Take a look at gold, up 8.5% over the last 2 weeks, back above 2,000. Wow, I'm not sure the last time it was at 2,000, Guy, but this is, again, one bright spot, and probably the fact that this haven's going higher may be suggesting it's not a buy the dip moment.
Yeah, I think we bottomed out on the 6th, I think, 6th of October, and then we've rallied really hard since then. Abigail, thank you very much indeed. Gold is a fantastic story to look at right now. In some ways, it's totally counterintuitive. You've got rising yields. That shouldn't be good for gold. You've got a strong dollar. That shouldn't be good for gold, yet gold is rallying. Gold's rallying, you could argue, therefore, because of that safe haven trade. Suki Cooper, Executive Director for Precious Metals Research, joins us now from Standard Chartered. Suki, is gold the right place to hide? Is there more to come? The bounce has been quite strong. Do you think we're done yet?
We saw a lot of those macro headwinds starting to build, and we were starting to look like we were going to get a retest of that 1800 level. But yes, it's been the resurgence in safe haven buying that has buoyed prices higher. What we tend to see when we have heightened geopolitical risks is that we have an initial rally as we see a move into the safe haven assets, the safe haven appeal. But thereafter, we tend to see that move tends to fade. Mm-hmm. We saw a very similar price reaction when Kuwait was invaded as well, and prices are currently trending at a very similar level to back then as well.
Suki, it's great to see you. I should point out that you're looking at the gold futures contract for December. Spot gold is still at 1990, so not at that 2000 yet, but you can definitely see it getting there. Suki, great to see you. If I look at the curve, are we actually going to get backwardated here? Like, there's been a real re-rating right at that front end in the last month or so. Is that a possibility?
If we see the gold market moving into a backwardated market, it tends to be short-lived. Ultimately, it's still the drivers around the macro factors that tend to be key in terms of the backwardation for the curve. So we're looking at the interest rates here, and currently we should still continue to see a positive yield. So if we do see a backwardated curve, we think it's most likely going to be short-lived.
Suki, who do you think is actually buying? Who's driving this right now?
This is a really interesting dynamic in the market at the moment. We're not seeing ETF holders coming into the market. In fact, we've continued to see huge net redemptions, and that has continued over the past week, even when we've seen this huge move in prices upwards. In fact, what we saw initially last week was short covering activity in terms of tactical investors, but towards the end of last week, we started seeing fresh long positions being established. So the latest data, when it comes out this week, will be key to track whether that momentum has continued. We're also entering a physically strong period for the gold market, a seasonally strong period for consumption. Mm-hmm. So if we were a market that had price dips, we might have seen that buying come back. but central banks continue to remain strong buyers here as well.
Why do you think that ETF gold buyers have been selling and not buying in this environment?
This is a really interesting dynamic when we look at the flows. One of the analysis that we like to look at is the price points where ETF holders establish those positions. And we're not in loss-making territory at the moment. If prices dip below 1800, we get another 100 tons that becomes loss-making, extra pressure to the downside. But at these price levels, one would be looking to be buying the dips, especially if you're looking to rethink the purpose of your portfolio, if you're looking for a safe haven asset and you're looking for a diversifier. But instead, the appeal of higher interest rates elsewhere, equity market performance elsewhere, has really weighed on the gold market. And as Guy mentioned, some of those key factors, the stronger dollar, high interest rates, have also capped gold's upside.
Suki, is gold the right metal to own? Do I want to own silver right now? Do I want to own gold? Do I want to own some of the other precious metals? How should we be thinking about which metals we want to own at the moment? Gold's kind of the most obvious one, but is it the best one?
It depends on which period we're looking at here. In the short term, gold, we think that could be exposed to further upside risk, but we think that the geopolitical premium that's being priced at the moment is likely to be short-lived. But beyond this, going into the back end of 2024, that's when we think that we're more likely to see upside risk for gold materializing, when we see confirmation that the Fed is likely to cut rates and interest rates around the world are likely to start to ease. But if we're looking across the entire complex, we're seeing some huge diverging trends at the moment, whether it's the palladium market, which is set to move into a surplus on a serial basis going into 2024 and beyond, whereas in contrast, metals like platinum and silver are more exposed to industrial demand growth driven by green energy and battery electric vehicles. So we'd say on a fundamental basis, platinum is perhaps the one that looks like it has the most upside risk if we're moving beyond 2024 and into 2025, 2026, when we anticipate larger deficits for that market. But in the short term, gold is perhaps the market we need to be keeping an eye on, especially with its safe haven appeal.
Suki, we had the data on what China was doing with treasuries, and I'm wondering, as China needs to support its currency, etc., does gold get wrapped into that? Like, are they going to have to sell their gold holdings to support their currency? I mean, the thesis 10 years ago for gold was that, hey, we're going to have a lot of central bank buying. Is that still the case?
What's been interesting about the China market is that we've seen buying on almost firing on all cylinders, whether it's retail investment demand, whether it's jewelry demand, whether it's central bank buying. All end uses at the moment look quite strong, but of course we're coming off quite a weak base from last year and the year before in terms of that retail appetite. But we are seeing a rebound in local interest in the gold market, whether that's on the back of concerns around the economy, the economic growth not being as strong as what was anticipated at the start of the year, or whether that's concerns around other asset classes. But the fact that we've seen China's imports remaining strong in excess of 100 tons for the bulk of the past year suggests that demand growth, that demand appetite is still very much there.
Suki, thanks so much. It's been so long. Suki Cooper, Executive Director for Precious Metals Research at Standard Chartered Bank. Thank you so very much. Nonetheless, Guy, when you're taking a look at sort of the safe haven bid, whether or not it lasts for a short or a long period of time, you're still looking at that 2000 if you're looking at December futures, and 1990 if you're looking at spot. I guess the question is, it just becomes expensive to store that stuff with yields high, so that kind of takes away some of the attraction at the same time. It's a commitment. If you're not buying it through the ETFs and you're buying physical gold, it is obviously a huge commitment that you're making. So this is not something that you can get in and out of relatively easily. So I think that's worth bearing in mind. I just find it fascinating that gold's rallied with so many of the headwinds against it. As Suki said, though, if we get to the point where the Fed says we're done, and that kind of headwind from rising rates starts to dissipate, you could see a definite move on the back of that. But on the other hand, you've got to kind of, I guess, factor in the fact that we're looking at rising yields regardless almost of what is happening with the Fed, which complicates matters. Which also just raises the question of cross-asset correlation, and if that makes sense. I was reading earlier in the week that with the rise we've seen in the bond market in terms of yields, the dollar maybe should be higher, or the dollar move should be higher than it has been. If you look at just straight up rate differentials, and it hasn't. So like, can we really use those cross-asset valuations?
Not sure. Not sure. An incredibly complicated market to navigate, I think, at the moment, which is why everybody's, even institutional money, leaving for the sidelines. See ya. You can deal with this later. I'm going into cash.
Yep. Yeah, but that was a great point. Money market funds, retail staying in, but institutional investors getting out of those money market funds. Anyway, speaking of, we're going to talk about ETFs. So new ETFs are riding on the coattails of Tesla's famous volatility. You definitely saw that with earnings this week. We're going to have some details on that. This is Bloomberg. It's time now for ETF Friday, and this week we're taking a look at a newly launched ETF that offers investors 2 times the returns of Tesla's volatile stock if you want it. Joining us now with more details is Bloomberg's cross-asset reporter Emily Grafeo. I mean, Tesla's volatile enough as it is, sure, okay, but how do these ETFs work?
Well, they have proved to work in the past. This is the first of its kind. We have a 2x leveraged Tesla from the issuer REC shares, and they also launched a 2x inverse Tesla. So if you want to short Tesla in a major way, you can also buy that fund. This is the first time that we're seeing the SEC actually allow a double leveraged single stock ETF. There are ways to do double or triple leverage indexes, but this is the first time they've actually allowed it for a single stock. Previous years, issuers have tried to launch these products and they hadn't been able to get it through. So we'll have to see. We asked the issuer, like, how did you actually make this work? And it's unclear what they did to assuage the SEC's concerns about volatility, but now they're launching.
Emily, who is this aimed at? Where's the appetite coming from?
I think it's really aimed at retail investors and other kinds of investors who want to ride Tesla's volatility. There's actually a ton of single stock leveraged 1.5 ETFs on the market, but the only ones that are actually getting inflows are ones that are really tied to Tesla. So we're seeing 1.5x Tesla ETF has grown to $1 billion in assets in just a year, which is a huge growth rate for these kinds of ETFs. So I think this speaks more to the appetite that investors in the ETF marketplace have to ride the Tesla volatility than trying to buy some type of leveraged or derivatives-based ETF.
How do we understand this in relation to other products like the spot Bitcoin ETF? Like it strikes me as odd, knowing as little as ETFs as I do, that like that they would approve these things but then not a Bitcoin ETF, right? Like, didn't we learn anything from when the volatility of the VIX ETNs like took out everything a couple years ago?
You are voicing the same concerns that a lot of spot Bitcoin ETF hopefuls have, because the SEC, not only have they approved this 2x Tesla, but they've actually also approved a 2x Bitcoin futures ETF. What? So I think a lot of my sources at least are saying, if the SEC is really here to protect retail investors, how have they approved 2x Bitcoin futures and not a spot? That's really the big question right now. Will we or will we not? At least in this case, this is a product that the SEC has voiced concerns about, and now they've let it through when it comes to 2x Tesla. So perhaps this bodes well for, if they voiced concerns about spot Bitcoin, maybe they're changing their tune, but we have to see.
We're all waiting for that moment. I suspect the Venn diagram overlap between kind of single-day options and some of these ETFs might be quite interesting. Great stuff, Emily. Fantastic to see you on a Friday. Every Friday. Emily's here. ETF Friday. Emily Grafea. Thank you very much indeed. So I understand, Alex, that there's shopping going on.
Okay.
Is this true or not?
It was Christmas shopping, and there were very good deals. So I am still technically in my budget.
Okay. Can I relate this to the Amex numbers today?
No, you can't. I mean, I have an Amex card, but clearly, I haven't been spending, but they still did okay.
They did amazingly. I tell you what I find amazing about the Amex numbers is the fact that people are paying up for cards, the higher price cards, and using those cards and the benefits